Billions are made and lost on the stock market each year, but the world of investing isn't just the exclusive domain of the ultra-rich or business savvy. Even if you're squirreling away just 20 quid a week in savings, investing could offer you the chance to get more out of your money. So if you're at the very beginning of your investment journey, this video will take you through the basics, as well as the top 10 golden rules that every investor should follow. Investing is the higher risk but potentially higher reward alternative to a savings account. When you put your money in a savings account, you can only ever make as much money as your savings rate allows, and in the UK, these rates have been pitifully low for a long time. So if you had an average savings pot of 6 to 7 grand, you'd have to wait 6 years to be able to afford a 100 quid pair of trainers with the interest alone. That means you'd have to wait around 28 years to buy a £449.99 PlayStation 5, 535 years to buy a new Ford Fiesta, and 16 months just to buy a cinema ticket or takeaway worth roughly 20 quid. To make matters worse, inflation rates have been rising faster than savings rates, which means your sweet little nest egg sitting safely in your savings account could actually be losing money year on year. When you invest your money, you take on the risk that if things go wrong, you could lose the lot. But if things go right, you can make a lot more money than if you left your funds in a savings account. You can invest in just about anything, from property and vintage cars to government bonds and pension schemes. But for most of us, when we talk about investing, we mean investing in stocks and shares on the stock market. I like to think of stocks and shares as slices of cake. Firstly, because it helps to visualise the more abstract elements of investing, and secondly, because cake is awesome. Let's imagine then that this delicious Victoria sponge represents a whole company like Apple or Amazon. When this Victoria sponge decides it wants to expand its horizons and get better icing or more high-tech buttercream filling, it's going to need to raise some money. One way to do this is by selling off a few slices to some initial keen cake connoisseurs, who then become partial owners. With the extra money, the Victoria sponge can upgrade its recipe, and the tastier the cake, the more people want to nab a slice, driving up demand and increasing the prices of the slices. Of course, you don't just find the slices of cake you want to invest in lying in the street. Instead, you head to a bakery where you can browse, buy and sell the baked goods that take your fancy. In this caketopian context, the bakery represents the stock market, a digital and physical marketplace where you can buy and sell shares. The UK stock market is known as the London Stock Exchange, or LSE, but you can use a UK stockbroker to access exchanges abroad like the Nasdaq or Shanghai Stock Exchange. As a side note, you'll often hear the words stocks and shares being used interchangeably. Now, there is actually a slight distinction between these two terms, but for the context of getting started in investing, you can basically think of them as the same thing. The general idea behind investing is to buy shares when their prices are low, and then sell when they rise to make a profit. Stock markets can be extremely volatile, and no investment comes without risk, so make sure you do your research and thoroughly understand what you're getting yourself into before you splash any cash. When you're just getting started, it's helpful to consider 3 key things. 1. What are your goals? Are you saving for your retirement fund, a family nest egg, or your dream home? What's your plan of action if prices start to rise or fall dramatically? 2. What is your time frame? Since long-term investments yield the greatest returns, you'll need to consider how long you can keep your money locked away in investments. 3. How much risk can you take? Different financial assets carry different risks. Consider how much you can afford to spend and how much you can afford to lose. If you want to start investing, consider getting a stocks and shares ISA. With a stocks and shares ISA, you won't pay income tax or capital gains tax on any money you earn from your investment. It's basically a great way to make your investments as tax efficient as possible. Whatever level you're at, most good investors will follow these top 10 golden rules. Number 1, keep emotions out of it. Investing is highly risky, and you'll need to keep a cool head in order to make the most informed decisions should your share prices rise or fall dramatically. Number 2, think long term. Aside from staying calm, the best way to weather any market volatility is to invest over a long period of time. This strategy also typically generates higher returns on your investment. 3. Avoid overtrading. Overtrading is where you buy and sell the same stock repeatedly in a short period of time and can seriously impact your returns in the long run. When stocks rise and fall, hold your nerve and remember your strategy. 4. Never invest more than you can afford to lose. When investing large sums of money, it can be helpful to have several months' worth of living expenses in a separate pot to protect yourself should anything go wrong. 5. Avoid the rumour mill. People are very quick to offer investment advice when it's not their money. Stick to advice from professional advisors or your own research. 6. That being said, do your research. Create a detailed list of companies you want to invest in and start tracking how well their stock performs. 7. Keep it simple and stick to businesses you know and understand. If you're not exactly sure how a company makes money, it might not be the best idea to invest in them. 8. Think in probabilities. For all its mystique, investing is a lot about making an educated guess, and there's loads of data out there to help you inform your choices. 9. Focus on what you can control. While you can't predict the market, you can build solid strategies and research the bejesus out of any company you want to invest in. 10. Diversify your portfolio. Having stock across multiple industries, products and countries could help spread the risk should one sector fail. Are you looking to up your savings game and turn that penny jar into penny stocks or more? Leave us a comment below with your thoughts. For more information on getting started in investing, check out finder.com/UK. Links are in the description below. Click here for our next video or subscribe to our channel here. Thanks for watching.